What are the tax implications of dividend income? Imagine earning money from your investments and then finding out that some of that money is taxed before it even reaches your hands. That's what happens with dividend income, which is the money you get when you own shares in a company. When a company makes profits, it can share some of those profits with shareholders through dividends. But the government also wants its share, so understanding how dividends are taxed is key for any adult investor. There are two main types of dividends for tax purposes: ordinary dividends and qualified dividends. Ordinary dividends are taxed at your regular income tax rates, which can range from 10% to 37% depending on how much you earn. These are the dividends that don't meet certain criteria and are taxed like wages or salaries. On the other hand, qualified dividends are taxed at lower rates, similar to long-term capital gains. To qualify, the dividends must come from a U.S. company or a qualified foreign company, and you need to hold the stock for more than 60 days within a specific period around the dividend date. The tax rates on qualified dividends for the year 2025 are 0% if your taxable income is below $48,350 for single filers or $96,700 for married couples filing jointly. If your income is higher but below certain limits, the rate is 15%. For incomes above the higher thresholds, the rate jumps to 20%. There are also additional taxes to consider. If your modified adjusted gross income exceeds certain levels, you might owe an extra 3.8% tax called the net investment income tax. This applies mainly to higher earners and adds to the tax on your dividend income. When you receive dividends, they are reported to you and the Internal Revenue Service on Form 109-9 Div. Your broker or the company paying the dividend will send this form. If your total dividends are more than $1,500, you will need to include Schedule B with your tax return. It's also important to remember that state and local taxes may apply to dividend income, and these vary depending on where you live. Some states have special rules or exemptions, so it's worth checking your local tax laws. Special cases include dividends earned on stocks you inherited. These are taxed like regular dividends, but the cost basis of the stock is usually stepped up to its value at the date of death, which can affect capital gains taxes when you sell. If a child earns dividend income above a certain amount, the kiddie tax rules might apply, taxing the income at the parent's tax rate. For adults planning their investments, knowing these tax rules helps in making smarter choices. Using tax-advantaged accounts like individual retirement accounts or employer-sponsored plans can help delay or avoid taxes on dividends. Planning when and how much dividend income to take can also help manage your overall tax bill. Keeping these facts in mind can help you keep more of the money you earn from your investments.